Hi guys, it's Birb here and welcome to the 4th episode of Weekend Chatting School. Today's topic will be Trend Analysis Part 1. Let's get shortly through the agenda as always. So we would kick it off from Introduction to Trend Analysis, moving on to trends for the types of trends, horizontal supports and resistances, diagonal supports, resistances, psychological aspects and factors to supports and resistances, moving on to demand and supply zones. Later we would wrap it up in summary and put it all for credits at the end. Firstly, we need to define and understand the concept and phenomenon of trend, right? Because the trend is a kind of a phenomenon. We can call it a social phenomenon happening for like between people. We can there is the definition taken from the dictionary. There would be a general development or change in a situation or in the way that people are behaving, right? So let's say if a crowd is following some direction in the street, right, when they're going all to their works in the street or so they would all be following and forming kind of a trend, right? So some repetitive form of behavior between different people. For the trend in financial markets, it obviously would be the similar a repetitive way represented in the form of a chart, of a price chart, that you can say clearly that the price action is following one way or another clearly, right? So it's not completely random for its meaning. And when we are to use the trends to define them, to analyze them from the financial point of view in our price charts, this would be the 4 factors that we would need to consider and present. This would be the direction, the volatility that it takes, which is the trend range, the price of it, I mean how the price follows, right, which way it follows, and the time it takes. So here is an example of US dollar to Canadian dollar forex pair starting from around, let's say, September of 2017 up to current moment, and there was an uptrend starting around this September, right, and it lasted until late June this year, right? This was an uptrend, and this uptrend was practically broken, which is represented horizontally by the break price, the maximum price that it did reach for its range, right? For the maximal price for that, it would be taken from the highest peak within the trend, right? Yeah, so we're having the factors of price, the factor of time, the factor of direction, right, which is diagonal here in the upward way, and as you can clearly tell, this is the volatility represented by the price range from its thrust price, from its anchor to its actual maximum within a given period, right? So these 4 pieces of information would be needed to use to define and analyze the trend properly. And when it comes to types of trends that we would differentiate, then we would need to focus on 2 different aspects, right? Firstly, we would need to define the trends in the meaning of directions that it take, right? This would be an upward direction, there would be like a downward direction and a horizontal direction, which provides us in a short way with uptrends, downtrends, and horizontal trends, or sideways, right, or ranging. Japanese market technicians would call it rectangle pattern, simply, until it unfolds, because it usually represents the distribution or accumulation cycle, right? If it's going on and happening at the bottoms of the market, this would be an accumulation. But if it's happening near some key resistances or you see something like that at all-time high, then this would be nothing that I would like to long for sure, right? At least until it breaks out successfully and retests it. So this would be the directional part and approach to define a trend. We can classify that regarding its complexity as well, right? So we can tell the difference between the primary trends, the secondary trends, and tertiary trends, right? So for this left bottom chart for Bitcoin US dollar inverse swap contract for BitMEX, the primary trend would be simply pointing out whether this is a bull market or bear market, right? The secondary trends would be these mid-time frame swings that you can tell that the primary trends consist of, right? I think this is very logical, and these secondary trends consist of tertiary trends, right? So these are more like local fluctuations, some local low time frame swings, plays, and this is all building. This is all building when gathered, combined, the secondary trends, right? So moving on to horizontal supports and resistances. Again, we need to define it well. To understand what it is, we need to define it well from the very beginning, right? So firstly, let's define what the support and resistance is, and then later cover that in the horizontal way perspective. So the support, what is the support, right? The support is a price level or levels that is very often associated with accumulation of long orders. When people buy and put their bids, put their long orders at certain price or around certain price, this means that they would believe that for some reason, fundamental or technical reason, this price would practically upswing at this round, around this support zone, right? While for the resistance, this would be accumulation of short orders, accumulation of asks, that people believe that the price action is not able or will not be able to practically cross over to break out above, right? This means that people would accumulate and put their asks around certain prices because this simply stems from their sentiment, right? This very often happens for psychological reasons. I mean, whole trading and whole technical analysis after that as well. These are all games of probabilities, games of psychological factors to people, right? Some behavioral financialists or analysts for fundamental reasons as well. These guys would practically follow what's going on inside people's head for their sentiment around certain price levels, right? So that if they know that people would fear certain levels, let's say round numbers, right? Every round number multiplied is a kind of like a milestone, right? So if Bitcoin first reached $1,000, right? So this was like a mess around it. This was like a big volatility around it. When Bitcoin for the very first time reached 10,000, this was another part, right? So we could expect people would practically, be somewhat fearing of this certain price level for some reason, okay? So people creating the market as well, obviously, people would fear naturally, subconsciously, some certain levels, and this is what creates their bias around these levels, the sentiment around it, and hence it creates both supports at the bottoms and resistances at the tops for the market to upswing or downswing, depending on the location, right? I think it's pretty clear. For the horizontal parts, we would need to simply make the support and how mark the support or resistance that would be horizontal, right? So that would be parallel to the time scale. The very first point step to spot horizontal support resistance would be to mark swings that you can tell from the chart, right? So if you were saying upswings, mark it as an upswing. If you were saying downswings, make it as a mark it as a downswing simply. And if you see subsequent quite non-random alignment for the swings, then you can tell there is a pretty decent chance that it is following some form of linear supports and resistance levels simply, right? Doesn't get any simpler than that. Then when we have already marked the swings, then we proceed to mark it with horizontal lines simply, right? And the spots in the chart that price formed an upswing, these would be marked as supports, right? And the opposite version would be the resistances. So the spots or price levels, certain price levels that market downswing from, then these little guys would be called the resistances, right? So if we are having horizontal supports and resistances, then for the price to proceed from the technical point of view, it does need to follow either breakout or breakdown, right? So if we want to strike through some resistance, then we could call it a breakout, right? So the price for some reason manages to break through some level that we would call a resistance, because of accumulated short orders around this price, then this we can call it a breakout, right? For the opposite direction, we could call it a breakdown, because the bullish structure that it's just used to be, and it is not anymore, because of the breakdown, then we call it a breakdown for the level, right? Yeah, as simple as that. Moving on to diagonal supports and resistances, we need to realize again the definition behind them, right? So having already known what supports and resistances are, knowing that these are like some certain price zones, levels around which people accumulate their long or short orders, then on the contrary to horizontal supports and resistances levels, we can find and differentiate as well diagonals, right? So diagonals are so called, people call it, technical analysts very often call it dynamic supports and resistances. Dynamic because they move, right? They are not static, because for horizontal parts, these are static simply. These are not diagonal. Anything that is diagonal is dynamic as well. So yeah, these supports and resistances that are forming higher lows in the chart for the price action, marking and forming some kind of a consequent series of points, placed on a linear curve, then more or less linear curve. Okay, this would be called the diagonal support. So the uptrend that the price finds the support at while moving on higher, this is the diagonal support, and the opposite direction would be the diagonal resistance, right? So the diagonal resistance would be the moving resistance, not static but dynamic resistance, that moves along with the price increasing, that simply once broken leads to new highs. That's obvious, but this is simply for a series of subsequent aligned in the form downswings, right? That would stop and build a bias sentiment, negative sentiment, fear sentiment around these levels for long investors. Yeah, going on to spotting and how to spot diagonal levels, support and resistances, then we would always need to start as well to make it clear from marking the swings, right? So again, the very same situation, we mark the upswings, downswings. Once we've done that, we go and proceed to conduct diagonal line from the anchor swing. Okay, so the swing, the very first upswing for longs that we decide for it to be the start or the anchor for the trend, for the support, dynamic support, and we mark it and conduct it, lead it through upswings until the trend simply breaks down, right? Yeah, so we have at the very beginning like quite a different slope, because we can easily tell that the very first swings are forming smaller slopes simply. The slope that is of a smaller angle, while after starting from the second upswing on the left half of the chart, this we can tell that we can see subsequent series of 3 upswings that right around May of 2019 or May or June simply is broken, right, for the chart. And this we can tell that this trend lasts from 29th of January 2018 up to around May or June 2019. Okay, so it is quite a large uptrend presented in the weekly chart of US dollar to Canadian dollar. So yeah, this is an example for forex players. When we go and check the right half of a chart, then to mark it as a diagonal resistance, we need to conduct a diagonal based on the anchor swing for the downswings, right? So we search the very first downswing that happened that we consider to start and form kind of a trend possibly, and then we mark it, lead it through all the upswings until the trend flips, changes its slope practically, right? So when we can see around 2019 New Year's Eve or the beginning or January, there was marked like a highest swing, like a peak of this move, of this uptrend lasting for a long time, right? This move was followed, this peak was followed by forming lower high, which only confirmed that the diagonal resistance acted as an actual resistance at the peak, right? Forming and making that following price action to form lower high and print like inability to make subsequently higher highs, right? So this is where the change happens for the trend, and this is where the trend ends practically. And then, just as every other horizontal support and resistance, the diagonals and dynamic ones are having obviously their breakouts and breakdowns as well, right? So the breakdown happens when there comes a change in the trend slope, in a trend angle. So we are marking the free swings. I'm looking at the left half of the chart. Free swings, and the fourth one is practically making a lower low, right? Which means that the series of ascending higher lows was broken at one point, and this point is represented on the right scale of the price scale with the break price, and this is what we call a breakdown of diagonal support. In the other direction, in the bullish direction, when we break descending series of lower highs, this is what we call breakout. So when we break out above dynamic resistance moving in downward direction, then this is a breakout, right? And very often, as you can tell by how it looks on the left and on the right, you can tell that there is a quite strong pressure to always test the breakout or breakdown. And this was as well the example for US dollar, Canadian dollar. I wanted to present it all in one chart simply to be easy, to make it easy to follow and compare easily with your knowledge and test later. Regarding psychological factors of supports and resistances, because it all happens and it all starts with people's head practically, right? Because for some reason they make their financial decisions based on some sentiment, be it their own sentiment or some group of people's sentiment, investors' sentiment. There are some measures all over the internet that you can find, like a fear-greed index, right? That would show you how, on average, what is the percentage ratio of people being more for fear, or those compared to those being more for greed, right? Building around that, so it all serves you as a trader, as a technical analyst, to find the bias around these parts, right? So every support and resistance is practically, from a psychological point of view, if you wanted to map it out, this would be like a zone that people are fearing most in the chart, simply, right? I mean, there would be like these layers, certain layers of prices, zones of prices that people would fear for some reason. And this can be, as I said, like technical reason or fundamental reason, or simply pure sentiment reason for some, because this is a round number, but it's having neither technical or fundamental explanation behind it. So this would be like a pure sentiment around it. So people, firstly, naturally, subconsciously fear round numbers. So as I said, like 10 and 10,000 million, and it's when you can multiply by 2 or any other digit, but these numbers with 1 being the first digit, or 2 or 5 are the strongest ones. Okay, you can dig in psychology as well for decision making, and especially for behavioral finance, that you can check it, how people react to these when they see that, right? For example, when you go shopping, right? When you go shopping, then you would rather much more see on your bill to pay, let's say, $9.99 instead of 10, right? For some reason, which is only, I don't know, only one cent or so, but still, people would fear that, right? People would feel bad if they paid like 10 instead of $9.99. So this is like another marketing trick, by the way. But yeah, this is for the round numbers. So people would naturally, just in case, right? When Bitcoin was hitting like 9,000 or around $10,000 per unit the other day, then I could see like people sending over that level simply easily, and you could tell that easily as well by watching any other lower levels like 5,000, 3,000, 4,000, 7, and so. The people were reacting very violently to these levels, and there is a reason behind it, especially when this is a price discovery. So they would just simply go, and when they're in long position, they would just simply take profit just in case, because people would naturally feel round numbers. Same goes for even or odd numbers, right? So people will naturally fear more, would be more less certain about round numbers than odd figures. So we can say that there is a decent chance that people would place their orders around 1900, 1997 instead of 200, right? And just to make sure that they get filled in case the other people fear 200 as well, right? There is an importance that I am using as well in my trading to about levels, the importance for entries, the importance for stop losses, for resistances, which is the take profit points as well. Then I'd rather always use odd figures instead of round figures, just like that. Okay, I'm doing that myself, like consciously, because I know there is such a thing and such a phenomenon, but still I do that because I know that people would be accumulating their short orders. Let's say if I am long, they would be accumulating these shorts, especially more around 200 than, let's say, 197 or 195, right? So the congestion of the shorts that would be smaller, hence I'm having like I'll be more likely to simply get filled with my take profit order. For the profit distribution under the take profit order type, again, these all combined, as I said above, like psychological parts, technical parts as well, and fundamental reasons as well, they will all influence the way we operate with take profit orders, right? So take profit would only act, especially if you are putting limit take profit, right, or market take profit. I mean, it's quite different, but for limit take profit order, you would like to have simply big chances or 100% chances that your order gets filled. And when you're putting like market price, market order, then you simply go for that, not to worry about it whether your order gets filled or not. So there comes like a bigger fee of that, for obviously because you're using the liquidity instead of providing the liquidity to the market. Hence they charge you for that. This is obvious. Yeah, so people would take profit around key supports and resistances, while we need to remember that supports and resistances are not like a one line. Okay, it's not working like that all the people, like every single trader all over the world trading Bitcoin, would place their take profit or resistance, simply would consider some level to be a resistance at one single price. So that would be, let's say if there is 100,000 traders at a time trading Bitcoin, it's not working like that. Everybody would put exactly the same, simply ask or bid. It's not working like that. So you're having always like a variety of these levels, which forms as well the price zones, the supply and the demand zones that we would be discussing in a second as well. So the profit distribution happens around supports and resistances, not at. We can project and expect that there would be like a greatest liquidity, simply because the more orders there would be, the more orders that could be filled at the same time, obviously, right? From the counterparty side. So yeah, we need to bear that in mind, that it's happening around these levels, not at these levels. I mean, it does happen as well at these levels, but to make sure and to actually manage your risk, this is part of risk management as well, to make sure that your order gets filled, right? Because if you're putting your order at 200, let's say for some reason, then you will need to very often stand in a queue long of hundreds of people or thousands of people that had put the same order quite earlier than you did. So this is, I think it's pretty clear, which you don't want, obviously, because there might come a situation that you don't get filled with that. Regarding the fear factor and greed factor and how it builds the sentiment around it, I prepared like a very short and concise table for you to read a sentiment and fear and greed around long or short orders and how they react. So long orders, long people that would be long, investors that would put long, these would fear. We can differentiate, like put like two different groups: those who would fear and those who would be greedy. So those fearful would set their take profit points below resistances, while those greedy, because they want simply more and more, even if it's 1 cent, and they are risking just not getting filled for some reason, because price may not necessarily reach this high that they put their orders at. So these would try to take profit as high as possible, and hence very often place orders, short orders, take profits above resistances, right? And when we reverse that for the shorts perspective, then we could see that those who fear would take profit above supports, and those who would be greedy about their shorts, they would be putting their take profit points or orders below supports, right? So this is like a reverse formation against long. This makes it very often presented in the form of normal distribution, which we would comment in a second. Same example, US dollar, Canadian dollar, weekly chart, and we can tell that left hand would print like a long position, while the right hand would print like a short position scenario. So when we longed for some reason, we had an amazing entry for long. We longed the very bottom, okay, and we can tell that gauging, by the price history, we could see that around like 1.379, okay, there 37.934. There was like a key swing that stopped the price to from continuing upwards, and from this price it started off the massive sell-off. So we can definitely say that this was marked as a strong resistance for some reason, and this prints a bias around this level as well, right? Because we don't want to be like even if we proceed to reach levels around this price, then we want to take profit firstly before the price reaches the spot practically, because we know that people for its being the resistance would accumulate their take profits or short orders for the long position around or at the simply resistance, right? So we want to make sure that we are getting filled and put our orders, short or take profit orders, in the fear zone, right? Because we fear that we don't get filled. Now, while some other people would place those greedy ones would place their orders, in a very aggressive way in the greed zone, right above the resistance, right, which they are risking not to get filled easily. So the fear zone would always be about making greater certainty that your order gets filled and you practically earn the profit that you fight for. So when we reverse that for the short order, and for some reason, we were such amazing guys. We were such amazing guys and traders, all of us, that we managed to short the very top, okay? We managed to short very downswing and the maximum value for the price that it reached around like 2016, February or so. Yeah, so we kept this short order. And could expect that, like, if you go and see the previous upswing before our short entry, the highest peak, you could see easily that there is like a key support held around like 1.19996 something. So this point is building a bias for us around it, and anything above for our short would be like a fear zone, because we still being close to that main support would be because we fear that we don't get filled, right? And on the contrary, there would be greedy people that would place their take profits as well in a more aggressive way to keep it below, right? Which they risk not to get filled. As you can see, this combines like a certain price zone for these take profit orders to simply find themselves to be there. And this is what I would discuss and present it to you in a way in a second. That would form demand and supply zones as well. So as I said, for the normal distribution is a statistical mathematical function that presents depending on the standard deviation, because obviously like the price is never practically following like with 100% accuracy this beautifully drawn trend lines, but they manage to swing up just right above it or just right below it, but it still counts as a trend support, dynamic support. This is all deviation. All these prices are deviated practically. So there comes like a phenomenon of standard deviation, like a mathematical function of normal distribution behind it as well, that we can say that the normal distribution peak, the graph of that, which you can tell from the left chart, would represent some maximum value reached by the greatest share of a sample, right? So it simply means that around the average of one standard deviation range, now we can say that there is a greatest majority of the sample of people, right? For example, presenting some certain value of some certain measures, phenomena, whatever. So I'm going all that for and to tell you that all these supports and resistances are based on these normal distribution as well, more or less, deviated in the left to the left or to the right a bit. like left tilted or right tilted a bit, because there are no ideals in the world, but it would still work. You need to interpret, to understand and see the concept of trends or supports and resistances, be it horizontals or diagonals. You need to realize that this is not only one price level, but this is actually not just right below or right above, like a certain zone of prices that people would interact with on a stronger basis than with other prices. And it all forms the price of presented in the form of normal distribution. So we can say that the peak of liquidity, the peak of the resistance, the greatest number of short orders would be placed at the main supports. But it doesn't mean that people will not accumulate their asks right above or right below for the fear and greed reasons, as I said. And it does count for both long and longer short positions, obviously. So going through and continuing to demand and supply zones, we need to define it firstly. And to define demand, this would be like a zone, like a price zone, that would be about accumulation of longs, okay, for the fear and greed reasons as well, because these fear and greed factors are creating the demand zone, right? So this would be like a price layer that would be associated and assigned for long orders to find a place for them simply, right? On the contrary to supply zone, which would be the accumulation of shorts for the fear and greed reasons as well. And the accumulation of shorts would be the price layer that people would accumulate their asks at and around, which means above and below as well, right? So the zone that the sellers are hiding in is the supply zone, and the zone that people and that traders, investors and long investors are hiding in would be the demand zone. And these would be very often like a strong congestion of support and resistance levels in the chart. Yeah, here's an example of how it works. Then you, like checking from the left hand, there was a like key swing, like a key swing that on the left, first upswing, that simply swinged on the support. Market sentiment around this level was strong enough to simply stop the downward trend, the low time frame or mid time frame. So there was a support marked, and the resistance that, as it says, that once got broken, that led to strong upthrust. So any level that you can tell, this is called like a pre-breakout level, right? So pre-breakout level, and there is this main concept that broken support turns into resistance, and reverse, the broken resistance turns into support. Hence, we can call it and label that as a RS flip, resistance to support flip. So broken resistance turned into support, which you can tell easily right after got tested, retested, and continued its way upward. Moving on to the central part, there is a main resistance. There was a main support previously, obviously before the flip. Main support that once broken led to strong thrust in downward direction, which we can tell that this level for investors was certainly important, because simply right after it was broken, the sell-off simply started. And this was like a support to resistance flip, and simply it became the main resistance. And the greed zone and the fear zone, where people would accumulate their take profit for longs, would collocate and connect and match with the various congestion of supports and resistances that market simply swinged around. So any stronger downswing that happened around the zone was simply it brings a picture that there must be some reason for that. There must be like a strong resistance zone for the market, and so we would go in fear to take profit safely, or greeded to take profit in a more aggressive way. And if we reverse that for the short orders, then we would market at the main support congested zone as well, from the left, just leading from the left side to the right. This would be, but the importance, just by the way, the importance, it moves in the other direction. Like the most important prices are obviously on the right, not to the left. But it's still, market found its sentiment around these congested support levels to resist the further breakdown in a way, which means that the market found the upswings in the zone, which makes it the demand zone the demand zone when people accumulated their long orders. So yeah, this is how it is, and to take profit early for the fear reasons, just to make sure that we get filled, we would place it right above the main support or right above the fear zone, right, or inside the fear zone. While if we wanted to make it more aggressive, then we could call it a greed zone and place orders, take profit orders there, but we risk quite a lot that we don't get filled because of the congestion of supports and congestion of proofs that people accumulated their long orders like crazy around these levels, right? So we risk a lot. Just to wrap it up, just to summarize, we define and differentiate trends for primary trends, secondary trends, tertiary, and for the classification and for the directional part breakdown, we could call them an uptrend, downtrend, and horizontal trend. While trends are social phenomena for people to follow certain repetitive pattern, social pattern. For horizontal supports and diagonal supports, these are the levels that investors consider to be for many reasons, including technical, fundamental, and sentiment reasons, the psychological factors, that they would believe that these prices would mark, say, the downswing for the previous uptrend or upswing for the previous downtrend. And so these are the spots, the price levels that market and price simply swings in the chart. And as I said, psychological factors, psychological reasons are mainly driven by greed and fear. These two are the strongest factors, are the strongest, let's say, psychological forces for us to make us do something, to make us do things, to make decisions. Simply the financial markets would care mostly about the fear and greed, and the reason that people fail is the greed. Well, actually, it's quite healthy to fear. If you fear buying Bitcoin around 3 to 4K back in months ago in December 2018, then it's good to feel this fear, because it means that you're not being greedy at this time. And reverse it. If you don't fear anything, if you are very enthusiastic and very euphoric about your decision, then you're simply being greedy. This is a simple way to how to recognize it and use it for your trading. Yeah, every support and resistance for technical and fundamental and psychological reasons, as I said, brings the sentiment, given sentiment around supports and resistances. So if you're playing long or shorts around key supports and resistances that you would like, key levels that you like to take profit around, you need to consider this very aspect of fear zone and greed zone. So imagine and try to come up with price layers, with price zones where greedy investors would put their ask or bid at or around, and same for fear zone. And yeah, to define and demand and supply, which includes and consists and bases on fear and greed phenomena for people, this would be in a short way to define it for the sellers or buyers to accumulate their positions, their orders around certain levels, but not at one level, but around levels. This is the key, which very often brings the picture of normal distribution, as I said. Okay, putting off all credits, I always suggest and recommend going for the book of John Murphy, A Technical Analysis of the Financial Markets. Go and check your free knowledge spot for investopedia.com, stockcharts.com, dictionary. Do always check dictionary for the definition, right? If you are struggling with comprehending some concepts, if you're not certain about some concepts, then go and check them in dictionary for what they mean. And for the birdness of our own material, that's it, guys. That's it. So just final remarks. Please follow us and don't forget to subscribe to our The Birb Nest YouTube, our official YouTube account that you would be watching this Weekend Chatting School Part 4, Episode 4 from this platform. Check out our YouTube, check out our Twitter, CryptoBirb, obviously, which is speaking right now. The Birb Nest as well, at The Birb Nest, our tag for Twitter, thebirbnest.com, and link to our Discord. Don't be shy to share that with your friends. Just a short reminder for trading therapy packages next to Social Media Pro and this very Weekend Chatting School that you can easily sign up for all of them for $9.99. This is a monthly subscription, so it takes less than a Starbucks visit, right? To actually get some good quality content, I hope. Just a short reminder, we are still having our ongoing sales for the Nest Club, which you can tell for the 25% discount right now compared to previous pricing. It's 50%. Go check out our website, scroll down as well to find our YouTube, to find our Discord link, to find our free Medium with new articles for the inefficient gap theory from Walter Wyckoff, and our Twitter. And guys, this has been my pleasure to introduce to you the Weekend Charting School chapter 4, and it was CryptoBirb speaking. I hope you enjoyed that, and hear you soon for the episode number 5.